Hello and welcome to How Inflation Can Impact Your Savings. Most people do not realize that inflation is a common occurrence in the economy. Sometimes it's easy to see, such as when gas prices go up. However, sometimes inflation can be hidden, and that type of inflation can have a significant impact on your finances without you even being aware. In this video, we'll explain how inflation affects your ability to build wealth and create financial certainty, along with how leveraging the unique characteristics used by the wealthy of a properly structured whole life insurance policy can help you reach your financial goals. So, what is inflation? Simply stated, it is a general increase in the prices you pay for goods and services because of a decrease in the purchasing power of your money. Now, inflation is created when certain conditions occur in the economy. For example, when there is an increase in the money supply, meaning the government prints money and injects it into the economy. Because there are more dollars in existence, each dollar is actually worth less. It takes more of them to buy the things you want. It also happens when there is a spike in demand for some product or service, such as what happened recently with used cars. When demand increases, or the supply of something decreases, the price goes up because people are willing to pay more for something they want or need. There's another type of inflation, which is called the wage price spiral. As prices of goods and services begin to rise, workers expect their wages to rise correspondingly. As employers increase the wages of their employees, the cost of producing the goods or services they provide also increases. Those increased costs are ultimately passed along to the consumer. Now, this increase in cost can further fuel the wage price spiral upward. In other words, it makes matters worse. Now, inflation is measured by what's called the Consumer Price Index, which tracks the average price of a basket of goods and services over a period of time. The CPI is the index the government uses to determine the annual increases of many government entitlement programs, such as Social Security. As a result, the government has every incentive to want the CPI to stay low. And so to accomplish this, they remove any item or items that are spiking or rising rapidly. That may cause the index to be higher than they would like. To put it bluntly, the government manipulates the CPI. Probably no surprise there. Now, let's look at how inflation affects your savings and how it can have a significant impact over time if you are not storing your money in the right places. As the cost of goods and services increases, the purchasing power of your savings decreases, as you cannot buy the same amount of goods and services for the same dollars than you could before. So for example, if you have $10,000 in your savings account today, and the inflation rate is 6.5% like it was in 2022, then you will need $10,650 to purchase the same goods and services that $10,000 would have bought previously. Here's another example. If your savings account is earning a 1% interest rate, at the end of the year, your account statement balance would be $10,100 before taxes. But if the inflation rate is 6.5%, during that time, your $10,100 would only have a purchasing power of $9,444. What this means is that you've effectively lost $656 in purchasing power. That's quite significant. Over time, because of inflation, you will need more and more money to purchase the things that you want and need. So now that we have talked about what inflation is and how it affects your savings and purchasing power, let's talk about what you can do to curb inflation, which means reduce the overall effects it has on you. When we are working with our clients, we are always showing them how to be as financially efficient as possible with everything they do. And one of the best ways to do this is to follow the lead of people who are already getting the results that you want to get. For well over 150 years, the wealthy have used properly and very specifically structured whole life insurance policies to curb or reduce the impact of inflation, at the same time protecting their assets while they are making money. Whole life insurance policies have a guaranteed cash value that grows over time at a rate that is typically significantly higher than that of a savings account. So in 2022, the average U.S. savings account paid only about 1/3 of 1% interest. But the average whole life policy during that same period of time paid significantly more than that. And when combining the guaranteed interest rate and the dividend, you ended up with a lot more money. This is just one of the many benefits of a whole life policy when it is set up properly. Another reason the wealthy use properly structured whole life insurance policies is that the cash value in the policy grows tax deferred, meaning there's no taxes being paid on the interest the money in the policy is earning. There's also a tax law that allows the cash value of the policy to be withdrawn completely free from income tax. By shielding the growth on the cash value from taxation, the wealthy reduce the effect of inflation on those dollars because the money is growing at a rate that offsets some or all of the inflation rate. And to reiterate, there is no tax. So it's a very powerful combination of interest rate and tax savings. The death benefit of the whole life insurance policy provides another inflation offset because it provides the beneficiaries a lump sum of capital that can be positioned in additional savings and investments or in additional whole life policies that could generate even more interest and more capital growth well above the rate of inflation. To learn more about the benefits of whole life and how it works, please take a minute to join our free member section of Strategic Wealth Builder, where we have a whole library of educational content. The best way to see if this strategy is a good fit for you is to schedule a no-obligation 30-minute consultation by clicking on the link below.